Wall Street is being taken over, and not by Ivy League grads or secretive hedge funds. It's AI. Entire trading floors have been slashed. Billion-dollar firms are handing decision-making power to algorithms. So the real question is, will AI replace human traders for good? Or is there still a seat at the table for you? Wall Street used to be all about instincts, connections, and guts. Now it's about code. Traditional traders are getting edged out by lightning-fast algorithms that never sleep, never panic, and process data in microseconds. Finance students and junior analysts are looking at a future where their skills might already be obsolete before they even get in the door. In this video, I'll break down what AI is really doing on Wall Street right now, which jobs are being replaced, and most importantly, where human talent still has the edge. If you're aiming to survive and thrive in this new landscape, this is your blueprint. But before we jump into it, if you're interested in mastering AI or having me build a custom automation for your business, hit the link below to set up a free one-on-one call with me to discover the possibilities. Now, let's get dangerous. Let's break it down into plain English. Then we'll tie it back to what it means for you or your team in real life. 1. High-frequency trading bots. In simple terms, computers that trade stocks super fast. So fast, humans can't keep up. These bots use AI and very low latency data to spot tiny price gaps, sometimes in milliseconds, across exchanges, and then execute trades automatically. One reference says that over 80% of trades in major markets are now carried out by automated systems. The human trader, whose job it is to simply watch the screen and click, is under threat because these bots can see and act on market changes faster than any human. They're not perfect. They still have risks and unintended behaviors, like they might accidentally collude with each other. But if you're relying on speed, manual execution reacting to visible market moves, you're already at a disadvantage. Think about how you can add strategic value. For example, setting the rules, designing the bots, auditing them, rather than being the one doing the high-volume clicks. 2. Sentiment analysis from news and social media. In simple terms, AI reads all the news, tweets, posts, and figures out how people are feeling, then acts on it. AI uses tools like natural language processing, or NLP, to scan large volumes of text, news articles, social media, and financial filings, and extract whether the sentiment is positive, negative, or neutral about a company or market. For example, a study found that AI could use news sentiment to predict stock returns. This gives firms an early warning or first mover advantage because they're acting on sentiment changes before the broad market does. It also moves the game from just what are the numbers to how do people feel. If you're a trader, analyst, or advisor who only looks at traditional data like price, volume, and fundamentals, you're missing a big piece. Knowing the narrative and how the market feels can become just as important as how the company is. And you'll want to think, how do I work with these sentiment signals and build rules around them? 3. Predictive modeling using machine learning. AI looks at lots of historical market data, learns patterns, and tries to guess what's going to happen next. Right now, firms are building ML models that take in vast price moves, economic indicators, alternative data sets, like satellite imagery, foot traffic, etc., and try to forecast future stock performance. One study at Stanford Graduate School of Business created an AI analyst that outperformed 93% of human mutual fund managers over 30 years. This means that humans doing the same data crunching and pattern recognition tasks as the AI are losing ground. AI isn't perfect, as it still fails with unexpected events, but it's getting impressive. If your job is simply to interpret data and pick stocks, ask yourself, are you doing something AI can do faster or more accurately, or something that AI can't yet do, like empathy, relationships, strategy, and ethics? Shifting toward the latter is how you protect your value. 4. Portfolio optimization and robo-advisors. In simple terms, AI helps build and manage entire investment portfolios instead of just picking individual stocks. Automated robo-advisor platforms and institutional tools use algorithms, sometimes AI, to decide how much to allocate to stocks, bonds, alternatives, etc., rebalance automatically and adapt as market conditions change. The newer generation of AI wealth management models are much more dynamic, using real-time data and personalization, not just set once and forget. Entry-level advisory and trading roles that simply pick a few stocks might get replaced by these automated systems. But again, the human who defines the values and context or exceptions still has a role. If you're providing portfolio advice or setting allocations, you need to show why your approach matters, what special context or personalization you bring. If your role could be swapped out by a robo-advisor tomorrow, start adapting. So in this section, you've seen how AI is actively operating in 4 major ways on Wall Street: lightning-fast automated trading, sentiment reading bots, predictive models that learn patterns, and portfolio managers that adjust themselves. All of these shift power away from purely human speed or manual repetition towards strategy, context, oversight, and value beyond raw execution. In this section, we'll break down which roles on Wall Street are truly at risk from AI and which roles still have a shelf life, at least for now. We'll keep it simple so you walk away with clarity and a bit of urgency. The roles at risk. 1. Execution traders and routine trading desk jobs. Think of the trader whose job is to get the order in quickly, watch price moves, click, and execute. That's exactly the kind of role where speed and data volume matter most, and where AI wins. Across finance, roles inundated by data, orders, flows, and volumes are highly exposed. The World Economic Forum notes that data-rich industries see faster AI adoption. A report predicted that up to 200,000 jobs on Wall Street could be cut as AI automation reduces the need for humans in repetitive finance tasks. 2. Quant analysis and junior research, or analyst jobs focusing on data crunching. Roles that revolve around reading spreadsheets, gathering data, generating basic models. Many of those tasks are being replaced by AI and automation. Because these tasks are structured, repeatable, and data-heavy, they're exactly the kind of job chunks AI excels at. 3. Back-office routine support roles. These include roles in operations, data entry, settlement, compilation of standard reports, where the variation is low and the tasks are repetitive. AI and automation are good at these. Roles still safer for now. 1. Relationship-based roles and client leadership. People who build trust with clients, read emotions, handle negotiation, and inspire loyalty are tougher to replace. 2. Strategic decision makers and big picture roles. When it comes to strategy, determining how to allocate capital, managing human organizational risk, setting the narrative, humans still have the edge. AI can provide tools and data, but humans still direct. 3. Compliance, ethics, oversight, and human-in-the-loop roles. As AI takes more tasks, someone still needs to check. Did the systems do the right thing? Is it legal? Is it fair? These oversight roles are growing. If you're in a role that is high volume, repetitive, and data heavy, Your risk is higher if you're in a role that is judgment-based, people-based, strategic. You're in better shape, but that doesn't mean you should sit still. What separates the two groups? The human edge, emotional intelligence, narrative creation, client trust, ethical judgment, and strategy. If you want staying power, shift your focus from doing tasks to owning outcomes, relationships, and strategy. In this section, we'll walk through 3 key ways in which AI, despite the hype, still has meaningful blind spots on Wall Street. We'll keep things simple so the concepts are clear and actionable. 1. Context blindness. AI doesn't get market psychology. Imagine an AI that knows every chess move possible, but it can't tell who's anxious, who's bluffing, or what's going on in the players' minds. That's how many trading AIs operate. They see data, not feelings. AI models are exceptional at spotting patterns in numbers, but they struggle to understand human emotions, narratives, and psychological shifts, factors that often drive markets. For example, they might see a stock price dropping, but fail to grasp that the drop is due to a CEO scandal, a viral social media post, or a sudden change in sentiment, elements that fall outside quant data. This matters because if your trading strategy depends solely on what the numbers say and ignores how people feel, you're missing a big part of the story. 2. Black swan events. Rare, big, and unpredictable. If you train a model by showing it hundreds of cat photos, it can learn what a cat looks like. But if someone shows it a mystical unicorn photo, something that's never seen, the model is lost. Black swan events are like that unicorn for markets. By definition, black swan events are rare, unprecedented disruptions that fall outside prior data patterns. AI relies on historical data and learned patterns. If the future event hasn't been part of the training set, or even similar, the model won't predict it reliably. A model may work perfectly under normal conditions, but when the unexpected happens, like a pandemic, a regulatory shock, or a geopolitical crisis, it can completely misfire. Firms can't assume that an AI model alone will save them when things go wildly off script. Human judgment, especially for the unknown, is still critical. 3. Regulatory and ethical constraints, and model risk. If the machine learning wizard casts a spell, but we don't know how it works or what side effects it has, that creates danger. That's the model risk. Also, if the rules of the game change overnight, the wizard can't update instantly. Regulatory frameworks in finance demand transparency, explainability, and oversight. Many AI models, especially the deep learning ones, act as black boxes, which makes trust, compliance, and auditing difficult. Predictions might fail because the model is based on flawed assumptions, biased data, or operates outside its intended environment. For example, the Bank of England has warned that AI trading systems could inadvertently amplify risk or even create instability if not properly constrained. Even if the technology works, if it fails compliance or regulation or acts unpredictably, your risk isn't just losing a trade, it's compliance trouble, reputation damage, and systemic exposure. AI is powerful, but it does not replace human judgment, especially in situations of emotional volatility, unexpected events, or ethical complexity. As a trader, analyst, or business leader, you need to be aware. What is your role that AI simply can't replicate? The answer often lies in context, psychology, oversight, and strategy. If you want to stay valuable, lean into the human skills that AI struggles with: interpretation, ethics, narrative shaping, and guiding the artificial intelligence. rather than simply being replaced by it. In this final section, we'll zoom out and look at where things are headed for roles on Goldman Sachs, JP Morgan Chase & Co., and the rest of Wall Street. Not just what's being replaced, but how the winners will operate in a world where humans and AI work together. 1. The rise of hybrid roles. AI strategist and quantitative trader with AI oversight. Research shows the future workforce will blend human talent with AI systems, especially in fields like finance. At Goldman Sachs, a recent view is that companies will start employing AI systems as part of hybrid teams. Humans will train them, manage them, and oversee outcomes. In the finance-specific field, a study by LSU Orso College of Business found that a human plus AI combination made more accurate predictions than either alone in certain stock analysis tasks. If you're in finance today, your target job isn't human trader doing everything or AI doing everything, but human and AI doing things together. Roles like AI strategist and quant trader with AI oversight or algo audit lead are what's emerging. 2. Humans setting parameters and AI executing at scale. AI is getting better at execution and pattern recognition, but humans are still needed to define the rules, choose what to optimize for, set risk tolerances, decide ethics boundaries, things like that. One industry insight says AI bots will be increasingly part of business workflows, but humans will still set the goals, judge when to override, and interpret results. In finance, the AI may handle rapid trades, data crunching, monitoring thousands of variables, but the human decides when to step in, when to pivot, whether the model's assumptions still hold. To stay ahead, move from I execute trades to I decide how we trade and supervise the system that executes trades. 3. Skills of the future: data literacy, algorithm auditing, and ethics in AI. A large-scale study found that demand for complementary skills, not just technical, like data literacy, judgment, oversight, and resilience, is growing fast as AI comes in. The PwC 2025 AI Jobs Barometer found that workers with AI skills earn about 56% more than peers without them in the same job. In finance specifically, setting the ethical boundary, managing AI risk, interpreting model failures, ensuring compliance and transparency will be high-value skills. Regulatory work around AI is increasing. Concrete skills to build: basic understanding of machine learning and AI in finance, even if you're not an engineer. Data analytics and alternative data use, algorithm auditing, knowing how the model works, where it fails, ethical awareness and regulatory knowledge, fairness, transparency, bias, systemic risk, and communication, explaining AI systems to clients, leadership, and non-tech stakeholders. The winner in the future isn't the person who just knows finance. They're the one who knows finance plus AI plus ethics plus communication plus oversight. The future is not humans versus AI. It's humans with AI. On Wall Street, the firms that succeed will be those that blend speed and scale of AI with human strategy, judgment, and trust. If you're a trader, analyst, or finance professional today, ask yourself, how do I shift from manual execution to strategic oversight, from doing the task to owning the process and supervising the machine? If you're ready to lead in this new world, now is the time to build hybrid skills, adapt your role, and position yourself as the human who commands the machine, not the machine replacing you. In the U.S. equity markets, algorithmic and computer-driven trading now accounts for roughly 60 to 75% of all trading volume. Goldman Sachs has explicitly described how it is using AI and automation to scale up productivity and build new workflows, embedding tools like GS AI Assistant firm-wide and focusing on AI adoption as a key driver of transformation. One report noted that AI applications in finance now make up over 50% of algorithmic trading patent filings since 2020, showing not just one adoption, but deepening investment in innovation. Real-world impact: firms are shifting their workforce and job mix in response. For example, Goldman's recent 1GS 3.0 initiative signals that roles heavily involved in routine tasks are being rethought in favor of higher value oversight and strategy positions. These data points show the transformation is already happening, not just coming. It's real and measurable. If you're interested in mastering AI or having me build a custom automation for your business, hit the link below to set up a free one-on-one call with me to discover the possibilities. And with that, be sure to leave a like, share your thoughts with the class, and before you subscribe, make sure you know what you're doing, because it ain't easy being at the top. I'll see you guys next time.